So once we understand that money is simply a store of value and energy, we can start to extrapolate off of that, and we can understand that when people are giving you sales or people are buying your product or service, it's because they're saying that you're giving them some type of benefit that is worth the stored time and energy that they've had, right? So, older people will pay for convenience because they have certain factors that affect them that they have to pay for in exchange for their stored energy and value that they've generated over the course of their lives. This is just economic fact. This is how most things work. So, what I want to talk about is how, as a business person, you should approach identifying products, building out certain types of, I would say, points of exchange, and how you should think about transactions as a whole and how you can benefit in any business that you do as long as you're on the right side of the overall tailwind environment. This is how the best, most sophisticated investors I've ever met do all their investing and all their business decisions. It's all based on this, right? So let's think about this, right? Let's say we're in a trending market environment. Let's say AI. Okay, cool. Oh, dude, this is too small. We need to make this bigger. All right, let's say we're in AI. Let's make it thick. All right, we're in A. It still isn't thick enough. Hmm. Okay, AI. Cool. We're in AI. We're in like this. We're in this industry. We're in data centers. We're in management, whatever, IT, cybersecurity, energy. It's an uptrend, right? Like the overall economy and the market is basically saying to Sam Altman, yo, we really like your stuff. We want you to keep doing it. You're making all our businesses very efficient. You're just an economic good for everybody. You're allowing us to conserve our energy. You're allowing us to spot inefficiencies in the healthcare system, which is super expensive. And this is basically off of the total addressable market idea, right? Like the bigger the market, the more people are spending money in that market to figure out a solution, right? So that's why when people say, "Oh, I don't want to go into that industry, it's super competitive." To me, I just say, "Okay, well there's a ton of opportunity there." Obviously there's red oceans and blue oceans, and you can read Blue Ocean Strategy and understand that. But the bigger the market, the more likely it is you're going to make money because of this one core principle, which I'm about to show to you. But before I show it to you, I want to lay some groundwork. I want to have you understand that in life, especially in the world we live in today, where dollars don't matter, fiat doesn't matter, everything is titles, everything is exchanging asset classes. We don't have this game where we're based on a gold standard anymore. There's a ton of debt, there's a ton of inflation. The only way to play this game appropriately is to become an asset owner. Okay, so I'm not even going to go into personal finance and how to save and blah blah blah. Like I'm not your financial advisor. I'm here to talk about business. So when you're building a business, you're building an asset. So we have this bullish asset class, right? And what is an asset? An asset is something that produces cash flow. Okay. So we're investing into something that we believe will eventually produce more cash flow than what we've invested into. Typically, there's something called a discount rate, typically at a rate that's greater than inflation, right? So that we understand that money is always being printed. We understand that there's corruption and politicians and disasters and tariffs and things that cause prices to go up. So what we want is we want our asset, our business, our properties, whatever, to outpace whatever average rate of inflation that is. Okay. And that's what we call our discount rate. And certain products or funds, based on their riskiness, will have certain discount rates associated with them. Once you understand this, we can equalize or normalize the distribution of assets across the entire investing landscape. Okay. So once we understand that every single return has a price, there's a cost of inaction, there's a cost of not even doing anything. But once you understand that, you can sit back, you know, be a little bit more refined with how you think about things, how you think about businesses and people making money. You see this all the time on like Instagram. Oh, I made $1 million in revenue last month. And if you're a sophisticated investor and you've studied balance sheets and you've studied publicly traded companies like the S&P 500, they're the best companies in the world. I don't really care what you're doing in terms of revenue. I want to understand the risks that you took to make that return, because when the economy goes south, when we realize that you've taken on too much leverage, when operational mishaps happen, and by the way, this entire game is execution risk if you're doing private equity or VC. When those things happen, because they will, I want to know that you have a system in your business model, in your unit economics, that will make you anti-fragile or robust. What is anti-fragile? It's things that gain from disorder. Robustness is things that don't lose or gain. They're more neutral when disorder happens. Like COVID, I was a trader. So when COVID happened, I was still working from home, working in the office, and it didn't materially affect me as much as it may have other people who have to commute for work, and now everything's shut down and they don't have a source of income. So that's fragile, that's fragility. So this is Nassim Taleb. Shout out to the GOAT. All right, so let's talk about assets versus liabilities. One man's asset is another man's liabilities. If you have a competitive product market fit proven business, people rely on your business to be stable and they will pay your business every month for the services, right? Like I'm making a Loom video. So Loom is a liability for me, but it's an asset for whoever owns Loom, right? Because I'm using their thing that they created, their product, and even though I'm paying them for the convenience of having my pretty face on the screen, they've got a bunch of back end infrastructure that they have to pay for. So I'm paying for the convenience of not having to go through the headache of managing Loom. I just get the final product and I don't have to worry. I save myself time. So Loom is my liability, but it's somebody else's asset. And this is the fundamental point, right? Somebody comes to your business, right? Your asset. And for them, it's a liability, but for you, it's cash flow. This is it. This is the thing that you need to understand. And what happens right around here is a transaction. And the more transactions that you have, so if transactions go up, your prices go up. Fundamentally, there's like hundreds of ways to price things in general. Okay. But fundamentally, the more demand there is versus your supply, the more you have pricing power, right? But we live in a competitive world and people are able to copy other people. And that's why fundamentally most moats are in the operational know-how and execution risk. I made a video on what VCs look for in startup companies, which goes into more, and I'll link it in the thumbnail. They go into more about like what competitive advantages are and why they're so important. But what we care about and why I'm making this video is to show you that you have a way to build an asset quickly. And the way you do that is by finding a good product in the TAM. So you see the trend, you see the good product, you understand that there's an asset, you understand that there's a liability, you understand that you need a certain type of cash flow that is better than the discount rate, right? And ideally, not just the discount rate, but the cost for you to live, the cost of reinvesting. This is why financial engineering and understanding financial systems before you go into a business is core. Because I see tons of people who do the first step correctly. They understand that AI is a big deal. They understand that they need to build a product or service in that niche because that's where the most money is. But they're getting lucky because they're letting the tailwinds and the power and the momentum of the industry juice their returns without highlighting the risks behind their business. So what we do at Green Mountain is we try to show you through a financial system how you can achieve the same type of return or better with the same or less amount of risk. And it's all about controlling the risk, because you have bubbles, you have crashes, and you're going to figure out who's swimming naked when the tide goes out. Shout out to Warren Buffett. So this is the whole point. And there are periods where you have structural, I don't want to say churn, but structural pass downs, where wealth is being passed down from generation to generation because people get older and they retire and they lose energy in their business. You have these business owners that are exiting their companies all the time. So if you want to get into a business that is producing money, why don't you go into a business that has an addressable market, has a thought out, built out business plan where you can come in and improve it? It's not going to be easy, but at least you have a winning shot because you already have some product market fit. You have a customer base, you have systems and teams and things that are already operating in the business to produce the cash flow it's producing. Now you're no longer a startup player, you're kind of private equity, like you're more sophisticated. And your goal is to understand transactions and how to build points in the business where you can have more transactions, right? And people will call them marketing channels and funnels and stuff like that. But the overall goal is to stimulate more transactions. And if you have a good understanding of accounting, or you know how to build financial systems, financial engineering, you can create more deals for that customer base to make them willing to pay for your product or service, right? Like, you can make payment plans, you can create special terms, you can make milestone based KPIs and payments around those milestones. Now, every time you do that, it's a financial headache for the accounting team. I know this because I do this all the time. But for you, it gives you the freedom as a business owner to make more sales and increase your transaction volume. And if you're working with the right type of fractional CFO or the right type of business partner or business coach, if you have one, they're going to tell you, hey, you need to basically state the price in different ways, right? And this is what Alex Hormozy talks about, but in probably better English than me. I I'm trying to speak at a fourth grade level, and it's the hardest thing ever, but I'm getting better at it. I'm trying. So what you're trying to do is basically just make it so easy for them to get your product or service, right? And as you get better in business and as you build results and you actually show that people are making money with you, people are getting a benefit that you're promising for them, it's not that like it's not that hard. It's not that, and that's why when people are like flexing, like, oh yeah, like we're doing blah blah blah. I'm like, bro, congrats, but it's whatever, right? Like there's other stuff in life, but getting the business sorted is what America's all about. The reason why we have so much wealth inequality is because people, I think there's a fundamental gap in like knowledge and education for people to feel like there's that next step. There's the ability to go and become a business owner and to own assets. A lot of people think that the American dream is just owning property. It's not. It's having ownership, period. Like you want to own assets in America. If you're complaining about the fact that people have businesses or assets, you don't understand how capitalism works. We live in a capitalist system. You can either accept the fact that you need to have assets and you need to be building strong products and you need to be an innovator, right? Or if not you need to go find the innovators and help them push their vision through. I've seen some amazing, like fantastic number twos that have helped their number ones push a great business forward, right? And the way you do this is by being obviously super ethical, but also just listening to what the market wants and studying the market. There are points where you can actually get a business quite simply, right? There's disruption, disputes, death, divorce, relocation, reasons why business owners move, and there's reasons why they're willing to make a transaction to sell their cash flow to you. When you buy a stock in the public market, it's the same thing. The company is selling its shares to you. Theoretically, you could buy the whole company if you had enough money or a way to structure a deal, and that's something that happens at the big scale. So basically, everybody in America can be a business owner within 2 years, in my opinion. They just need to understand where they're at personally and where they fit into the current market environment, right? Like if I'm making a certain amount of money, I have to live within my means. It goes the same way with acquiring businesses to a degree, of course. As you get better and as you build teams and as you have the right partnerships for financing, it gets a lot easier. But what you really have to understand is we're all about making transactions in the US. We're all about saying, hey, the growth is in the transformation. It's not in, having an overnight success. When you see somebody who's successful in business, you have to understand that it's impressive because they went through decades of learning how to do things the right way to build something that people want. They had to learn a lot of stuff, and there's a lot of growth that happens there. And they're also willing to take the risk and constantly reinvest in themselves. So ultimately, I really just want this message to be about taking more bets on yourself and thinking about the overall market and economy. The hardest thing that you're going to have to deal with is finding the right product that you want to run with. Okay. And that's why you see successful people say, oh, find your passion, right? Or find the cause that you want to fight over. Because it becomes easier to become wealthy if you're actually motivated to get up and do stuff. Like the guy who's selling concrete probably has a harder time being motivated to go to work every day than the other guy who's building the next cure for cancer or whatever, right? So depends on the battle you have, but it's really a spiritual and personal journey. But in reality, the only thing that matters for a successful business is sales growth and sales velocity. There's tons of marketing channels to get to that point. Once you have a good back end system and a product to run with, it's the last piece of the puzzle. That's why marketing agencies are making tons of money if they're good. If they're bad, they usually churn through clients, and then the free market usually says like, "All right, you ran out of money, go get a job." You know what I mean? But the best marketers, the best of the best, are never worried about their position in the market, quote unquote, because they know that this is the game. Like they study the trends, they study the markets, they have the good financial systems, they can manage their risk. This is ultimately what the American dream is about. The American dream is about owning assets, and that's what we do at Green Mountain. So I hope that you got something out of this. I'm always open to talk to new business owners or people with exciting products and stuff like that. So yeah, have a great day or a good night if you're watching this in the evening, and hope to catch you again in the next video.